General Dynamics is a $78 billion company built around a simple proposition: manufacture the systems that the U.S. military and its allies can't acquire anywhere else. Virginia-class nuclear attack submarines, M1 Abrams tanks, and Gulfstream ultra-long-range jets occupy production categories with exactly one or two qualified manufacturers in the world. That's not a competitive position. It's a structural monopoly.
The backlog tells the story. $91.3 billion at the end of 2024, up 15% year over year. That represents roughly 2 years of forward revenue already committed by customers. Defense contracts of this scale don't cancel. They extend, they expand, and they generate follow-on sustainment revenue for decades after the initial delivery.
The company's origins trace to Electric Boat, founded in 1899 as the first commercial submarine builder for the U.S. Navy. General Dynamics was formally incorporated in 1952, consolidating Convair, Electric Boat, and other defense manufacturers. Over 70 years, it divested the businesses that weren't defensible and concentrated on the ones that were.
The Virginia-class submarine program is the crown jewel. Electric Boat is one of only 2 companies authorized to build nuclear attack submarines for the U.S. Navy. The other is Huntington Ingalls. The Virginia-class backlog is $48+ billion, and AUKUS, the arrangement to provide Australia with nuclear submarines, is adding demand beyond what U.S. Navy budgets alone can support.
The Gulfstream acquisition in 1999 for $5.3 billion was the strategic insight that distinguishes General Dynamics from pure defense primes. Business aviation is structurally secular. The G700 and G800 jets at $75 million each are bought by corporations and sovereign wealth funds who don't cancel orders because of interest rates. Gulfstream delivers 25% of GD revenue with operating margins comparable to defense programs.
Phoebe Novakovic became CEO in 2013, the first woman to lead a major U.S. defense firm. She came from the CIA, the Pentagon, and 12 years inside General Dynamics running marine systems. Her background in national security policy gives her unusual credibility in Washington discussions about which programs get funded and which programs survive budget negotiations.
The Ukraine war catalyzed a NATO defense supercycle that is the most significant tailwind for GD's combat systems segment in a generation. Germany is now buying Abrams tanks for the first time. Poland signed the largest tank procurement in NATO history. Romania, Estonia, and Latvia are all expanding armored vehicle inventories. International orders are now 40% of combat systems bookings.
The Technologies segment, GDIT, the Defense IT division, is the hidden compounding engine. $25 billion in contract portfolio serving the intelligence community and Department of Defense with cybersecurity, C4ISR, and cloud infrastructure. Security-cleared workforce contracts don't come up for rebid frequently, and when they do, the incumbent wins most of them because the clearance depth is irreplaceable.
The 4 segments are beautifully balanced. Marine systems at 27%, aerospace at 25%, combat systems at 24%, and technologies at 24%. No single segment is more than 27% of revenue. That diversification means a Gulfstream delivery slowdown doesn't threaten the submarine program, and a submarine budget delay doesn't threaten Abrams tank orders.
32 consecutive years of dividend increases through Gulf War, 9/11, the 2008 financial crisis, and COVID. That's a dividend aristocrat track record that only defense companies with genuinely non-cyclical revenue can maintain. Defense budgets have grown in every decade since World War II. The dividend reflects that structural reality.
The dividend has grown from $4 for annually in 2019 to $5.68 in 2024, a 40% increase in 5 years. The consistency and growth rate reflect a business that generates 95% free cash flow conversion of net earnings. Very few industrial companies maintain that conversion discipline across cycles.
On the competitive radar, GD scores 92 on both submarine program moat and Gulfstream brand, the 2 assets that have no equivalent competitor. Lockheed Martin scores higher on overall defense backlog and NATO tailwind exposure because of its F-35 program, but cannot match GD's submarine monopoly or civilian aviation hedge.
The global network serves 45-plus countries, maintains a security-cleared workforce of 40,000-plus, and produces nuclear submarines at a rate of 2+ per year. a production tempo constrained by skilled labor availability, not customer demand. The Gulfstream delivery backlog extends past 2028 at current production rates.
General Dynamics operates in the part of the defense budget that doesn't get cut. Nuclear submarines are a strategic deterrent that Congress funds through every recession. Abrams tanks are the cornerstone of NATO's ground defense doctrine, and Gulfstream is the one luxury product that corporate boards approve even when they're cutting everything else.
The investment case today is about the NATO defense spending supercycle. Every European NATO member is increasing defense budgets to meet the 2% GDP commitment, and they need Abrams tanks, submarines, and defense IT infrastructure that GD supplies. The $91 billion backlog already prices in 5 years of production, and the pipeline of new international orders suggests the backlog continues growing. General Dynamics reported Q1 2026 revenue of $13.14 billion, up 14.4% year-over-year, beating the $12.6 billion estimate. Adjusted EPS of $4.10 beat the $3.68 estimate by 11.4%. Backlog hit a record $188.4 billion. Gulfstream delivered 24 aircraft versus 11 in Q1 2025. The stock rose 9 to 11% after hours.
General Dynamics was founded in 1952 and is headquartered in Reston, Virginia. The company operates 4 business segments: aerospace, the Gulfstream business jet division, designs and manufactures the world's most advanced ultra-long-range business jets. Marine Systems builds Virginia-class nuclear submarines and surface combatants for the U.S. Navy through Electric Boat. Combat Systems produces Abrams tanks and Stryker-wheeled vehicles for the U.S. Army and allied nations. Mission Systems provides command, control, communications, and intelligence technology across all U.S. military branches.
At $72 billion in market cap, General Dynamics trades at 17.2 times forward earnings, in line with defense peers. CEO Phoebe Novakovic has led the company since 2013. She has overseen the Gulfstream integration and the company's consistent capital return program. General Dynamics has raised its dividend for 24 consecutive years and yields approximately 2.2%.
Q1 2026 revenue of $13.14 billion beat the $12.6 billion estimate, a 4.3% outperformance. Revenue grew 14.4% year-over-year. Adjusted EPS of $4.10 beat the $3.68 estimate by 11.4%. Adjusted operating margin was 10.1%, expanding 50 basis points year-over-year.
Backlog hit a record $188.4 billion, up 12.3% year-over-year. Backlog represents 3.6 years of annual revenue coverage. Every segment contributed to the backlog build. Defense spending from NATO commitments, European rearmament, and U.S. DoD budget expansion are all flowing into the order book simultaneously.
The aerospace segment, Gulfstream, reported $2.82 billion in Q1 revenue. Gulfstream delivered 24 aircraft in Q1 2026 versus 11 in Q1 2025, a 118% year-over-year increase. The G700 ultra-long-range jet and G800 global-range jet are both ramping toward full production. Business jet demand from the wealth effect and corporate travel recovery is driving order flow.
Marine Systems, Electric Boat, reported $3.51 billion. Virginia-class submarine production is the Navy's highest priority shipbuilding program. Electric Boat is the sole producer of Virginia-class boats, and the Navy has committed to increasing production rates from 2 to approximately 2.3 submarines per year under Block 6 contracts. Revenue grew 13% year-over-year.
Combat Systems reported $2.26 billion, up 15% year-over-year, driven by international Stryker and Abrams demand. Poland, Romania, Germany, and Baltic states are all actively expanding armored vehicle fleets. Mission Systems reported $3.4 billion, up 11%, driven by C5ISR systems demand and classified program growth.
Operating cash flow in Q1 2026 was approximately $820 million. Management raised full-year 2026 guidance. The Q2 2026 guidance implied 10 to 15% revenue growth year-over-year. The guidance raise validated that the Gulfstream delivery acceleration was structural, not a one-time surge.
Phoebe Novakovic became General Dynamics CEO in 2013, having previously served as president and COO. Before GD, Novakovic worked at the Central Intelligence Agency and the U.S. Department of Defense. Her leadership style is disciplined. She has focused on operational execution, margin expansion, and consistent capital return. Under Novakovic, GD has raised its dividend for 24 consecutive years while maintaining investment-grade credit.
Analyst consensus heading into Q1 2026 was approximately 15 buy ratings, 7 holds, and 1 sell. The average price target was $295, representing 11% upside from the pre-earnings price of $265. After the beat, multiple analysts raised targets above $310.
The bull case on the street centers on the defense spending supercycle and Gulfstream normalization. At 17.2 times forward earnings, GD trades in line with defense peers while offering Gulfstream as an incremental growth driver that pure-play defense contractors lack. Morgan Stanley maintained overweight with a $310 target, citing backlog record as confirmation of multi-year visibility.
JP Morgan raised its target to $315 post-earnings, arguing the Gulfstream delivery surge was the defining data point. 24 aircraft in Q1 compared to 11 in Q1 2025 proves the production ramp is executing. A sustained 20-plus aircraft per quarter delivery rate implies aerospace segment revenue of $11 to $12 billion annually at full run rate, a meaningful re-rating catalyst.
More cautious voices noted the marine systems margin challenge. Electric Boat has faced labor cost inflation and productivity headwinds as it scales production rates. If submarine profitability stays compressed, the overall GD margin story stalls. Marine Systems operating margin was approximately 9% in Q1, below the corporate average.
Consensus takeaway: the quarter confirmed the Defense plus Gulfstream thesis is executing. The backlog record at $188.4 billion provides 3+ years of revenue visibility. The risk is execution. Gulfstream production must sustain delivery rates, and Marine Systems must normalize labor costs.
The bull case is a dual-engine re-rating. General Dynamics is the only major defense contractor with a leading business jet franchise. As Gulfstream deliveries normalize at 150-plus aircraft per year, aerospace segment revenue reaches $12 billion annually, approximately 20% of total GD revenue. That mix shift justifies a premium versus pure-play defense peers.
The defense supercycle is a decade-long tailwind. NATO expansion, European rearmament post-Ukraine, and rising U.S. DoD budgets are structural, not cyclical. GD's combat systems Stryker and Abrams programs are direct beneficiaries. Every new international order adds to backlog without requiring new R&D investment. These are mature, proven platforms.
Free cash flow normalization is the third catalyst. GD's FCF has been suppressed by Gulfstream production ramp costs. As production stabilizes at full rate, FCF conversion improves to 90 to 100% of net income, implying $4+ billion in annual FCF by FY 2027. At 17 times forward earnings, GD offers defense value with aerospace growth optionality.
The bear case starts with defense budget risk, U.S. federal spending uncertainty, continuing resolutions, debt ceiling negotiations, or a sequestration scenario could freeze DoD contract awards. Combat systems and marine systems are highly dependent on annual appropriations. A prolonged continuing resolution would delay submarine contract awards and push Stryker deliveries into later years.
Gulfstream execution risk is real. The G700 and G800 production ramps require thousands of supplier components and coordinated final assembly scheduling. Any disruption, a GE aerospace engine delivery delay, avionics supply shortage, or labor action at Savannah, could push deliveries out of the quarter and compress aerospace margins. Gulfstream is the highest margin segment.
Marine systems labor costs are the known margin headwind. Electric Boat is competing for skilled trades workers in a tight labor market. Welders, pipe fitters, and nuclear-certified workers command significant wage premiums. If labor cost inflation outpaces the Navy's price escalation provisions in Virginia-class contracts, marine margins compress further.
China business aviation risk is binary. A U.S.-China trade escalation or technology export restriction could shut Gulfstream out of the Chinese market entirely. China represents a meaningful portion of business jet demand globally. An adverse ruling or diplomatic incident could reduce Gulfstream order flow and pressure the backlog.
The defense peer comparison, GD versus Lockheed Martin, Northrop Grumman, and RTX. Lockheed at 16.8 times forward earnings is the closest peer, pure-play defense with no commercial aviation exposure. Northrop at 17.5 times is pricing in classified program growth and space systems. RTX at 18.4 times reflects the engine aftermarket premium from LEAP and GTF engine fleets.
GD at 17.2 times is in the middle of the defense peer range. The Gulfstream franchise is the differentiator. No other top 5 defense contractor has a comparable commercial aviation business. When defense multiples compress, Gulfstream provides a valuation floor. When business aviation demand surges as it did in Q1 2026, GD can re-rate higher than pure-play defense peers.
Boeing at 58 times forward earnings is not a fair comparison. Boeing's multiple reflects recovery normalization after 2 catastrophic years, not core valuation. The relevant defense comps are LMT, NOC, and RTX, where GD at 17.2 times is slightly below the group average of 17.6 times.
The peer takeaway: GD trades at a fair to slight discount to defense peers despite having unique commercial aviation exposure through Gulfstream. If Gulfstream re-rates toward business jet peer multiples, Textron Aviation, or Dassault, the blended GD multiple expands. The current pricing does not fully credit the Gulfstream optionality.
Pre-earnings options positioning was moderately bullish. The put-call ratio was approximately 0.74. The options market implied a 5 to 7% earnings move. The actual 9 to 11% after-hours gain exceeded the implied move, confirming that even bullish options traders underestimated the Gulfstream delivery surge.
Post-earnings call activity targeted the $270 and $280 strike calls for June. The thesis: GD's strong beat guidance raise pattern after Gulfstream surges historically extends over the following 2 to 3 weeks as institutional rebalancing toward defense plus aerospace exposure occurs. The backlog record also triggered program trading buy signals in defense ETFs.
CEO Phoebe Novakovic and GD's executive team participate in standard equity compensation programs. General Dynamics returned $250 million in buybacks in Q1 2026. The company has a consistent buyback program targeting $1 to $2 billion annually. Novakovic's compensation is tied to free cash flow conversion and backlog growth milestones.
General Dynamics has raised its dividend for 24 consecutive years, from $4.40 in FY 2020 to $5.88 in FY 2026 expected. Free cash flow of approximately $3.4 billion covers the annual dividend approximately 3 times. The capital return program is consistent and predictable, making GD a core holding for dividend growth investors.
General Dynamics delivered 14% revenue growth, 11% EPS beat, record backlog at $188.4 billion. Gulfstream delivered 24 aircraft versus 11. Guidance raised. The thesis is executing. At 17.2 times, GD offers value with FCF normalization.
Risks are real: defense budget sequestration, Gulfstream execution, marine labor costs. Watch Gulfstream deliveries above 20 per quarter in Q2 and Marine Systems margin for electric boat labor. 24 consecutive dividend growth years is the floor. The backlog record is the ceiling. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.